About the NASDAQ down another 0.5%. Michael Lee's here in studio. Michael, great to see you. You called yesterday's gains a FOMO rally, a fear of missing out rally. Is there anything I should be looking at right now to make some money in this environment and the second half of the year?
Well, look, we're in a tale of two cities with this market, right? Where you have 6 or 7 stocks leading the way, all based on this artificial intelligence, and then the rest of the market is essentially flat. And what we've seen this year is what normally doesn't happen. So when you have contracting liquidity, declining earnings, slowing economy, you normally get price to earnings multiple contraction. We've had price to earnings multiple expansion by roughly 30%. So I'm inclined to say that the momentum behind these big tech names doesn't stop, because this artificial intelligence trend is for real. NVIDIA gave us the biggest guidance in the history of the world, literally. Accenture's hiring another 40,000 employees to work just on artificial intelligence. Right. But that being said, so the way that I would play that is with the XLK, the tech sector ETF, because you're going to have exposure to all those big names without having to pick the individual winner. But I'd also barbell that with some conservative names. A name that I like, that David likes, that just mentioned, is Truist. Yeah. You know, you have roughly a 7% dividend and a 7% price to earnings multiple. Right, and so if it's something that you can sit on and wait, I think that'll pay off for you over time. And then I also own the 30-year Treasury, the TLT. In case the bottom does really fall out of this market, you'll get a substantial rally in that.
It's interesting. You say, look, the most recent economic data, it's very hard to pass each individual, but it's generally been positive. You think that the stock market is saying, you know what, I think we're out of the woods. You don't necessarily think that's true.
So, you know, yesterday we got some decent economic data, right, in the form of durable goods and some good housing data. Yep. But you know, by and large, this is still a slowing economy, and a recession is still highly likely to happen, albeit maybe a minor one. And if you look at gross domestic income, we are already in a recession. Yeah. That being said, the stock market's not the economy is not the stock market, and if this artificial intelligence trend continues, which I think it will, you could have fairly decent stock market performance, because the big names that are going to benefit the most from this trend make up a massive portion of the overall indices. So you're in this bifurcation where you have some individual winners that happen to be the largest companies in the world that dominate the overall market indices, whereas the rest of the economy is not doing that well. And earnings estimates for next quarter are for a decline of 6.5%.
Frankly, I find the whole thing incredibly confusing. It's a very hard market to read, wouldn't you agree?
This is absolutely one of the most difficult markets I've ever been involved in, because the NASDAQ's up 30% year to date. Yeah. But like I said, the economy is doing terrible. Not terrible, but it's getting worse and worse and worse. Okay, and liquidity is tightening. And so the Fed's most likely going to raise another 25 basis points. If we get more strong economic data, you're looking at more hikes in addition to that, which is kicking rate cuts down even further into 2024. So normally in these environments, you want to run for the hills and buy defensive stocks, but that hasn't been the case this year.
Fascinating. All right, thank you very much, Michael. As you can see, they're all shouting and waving and pumping their